Thank you for joining us here for our weekly investment audio cast that we call Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer here at Signature FD. So some weeks are pretty quiet, and others are anything but that. And this week looks to be in that latter category. So I'm just going to go ahead and get right in to things with a review of the markets and the data from last week, as well as what we're watching in this week ahead. So last week, the S&P 500 fell about 2%. Now, much of that was concentrated in a move on Friday. Bonds balanced out stocks in a balanced portfolio, and in aggregate, bonds advanced a little over 2% as interest rates fell. Now, there was a number of impactful data releases on the labor market specifically last week, and they all told a similar story. And that story is that there's a notable slowing in the labor market, and that's been transpiring over the past few months. So early in the week, we got data from June on job openings, and that showed that openings continued to ease, and also the hiring rate and the quit rate, both of those fell. Now, each of these coincide with a softer job market. And then we got data from payroll processor ADP, and they reported weakness in payrolls. Now, to be clear, payrolls aren't contracting, but less new jobs are being created. And that data was corroborated by the official BLS employment situation report on Friday. The last report is the one that jolted the markets, that Friday report. The unemployment rate moved higher from 4.1% to 4.3%. Payrolls expanded 114,000, and estimates from our friends at BCA Research that suggests that that's just not enough. Expanding 114,000 jobs is not enough to feed the amount of new entrants into the workforce that we're getting every month. Their estimate is that you need to create about 140,000 new jobs to keep the unemployment rate stable. So even though we're not seeing recessionary job destruction, we're not seeing enough job creation to absorb a growing labor force. Now, some other data in that report was also soft. The average work week fell by 1/10 of an hour. Wage growth missed analyst estimates. Wages grew 3.6% year over year. And that's a healthy rate, but the concern is that it's been steadily easing from very high levels in years prior. Now, the BLS report specifically cited that weather was not an impact. However, according to our friends at Ned Davis Research, the underlying data seemed to be littered with weather distortions. One example was that there was a record 461,000 people reporting a temporary work disruption due to weather. The average for July is 41,000, so that's about 10 times the amount of people. Even so, the broad preponderance of data suggests that labor markets are weakening, not strengthening. So that brings us to central bank activity last week. It was a Fed meeting week. The Bank of England cut rates, and they followed other major central banks like the European Central Bank and the Bank of Canada. But the US was something of an outlier because they held rates steady. They did not cut last week. Now, the corrective action late last week, with follow through here early in this week, has a lot to do with fears that the Fed is now behind the curve. The Fed held rates steady, but in his press conference, Fed Chair Powell expressed a comfort level with cutting rates for the first time in September if the data continues to evolve the way it has over the past several months. We think it's going to. The labor market is no longer a source of inflationary pressure, so policy rates do not need to remain as restrictive. Now, the Fed is something of an outlier in holding rates steady, but the Bank of Japan is going the other direction entirely. They began to hike interest rates. Now, the impact is that interest rate differentials among major economies are narrowing. The yen had been extremely weak, but has made a very strong move higher recently. And that's resulted in a full bear market in Japanese stocks over the course of just 3 trading sessions. Now, as the yen has strengthened, that's also had a negative effect on other assets across the globe. And that's because of this so-called carry trade, where investors borrow in yen because the interest rate was zero, and they buy other assets with a higher expected return. All of what we've just talked about has really kind of come together to result in a pretty large spike in volatility. Now, 2024 has been a very low volatility year up to this point. One thing we do know about markets and market volatility is that volatility tends to mean revert. In other words, low volatility periods eventually give way to higher volatility periods and vice versa. Now, the good news there, according to our research partners at Bespoke, similar volatility spikes to today have tended to see stocks gain more than average over the course of the next year. We would keep in mind that volatility does tend to beget more volatility in the short run, though. So we would have an expectation that relatively large daily swings will be more likely in the next few weeks. That said, the best days in the market have tended to cluster around the worst days. So expect that volatility to cut in both directions. Now, in the longer term, what's going to be important is corporate earnings. On that note, the labor market data last week probably overshot the true economic deterioration given those probable weather impacts. Now, lower rates, that could be something that helps to elongate the economic expansion. One thing I'm really keeping an eye on here is how much mortgage rates begin to come in. Towards the end of last week, a 30-year mortgage was around 6.4%. Rates in the 5% range, that could be a very psychologically important level. And that could have the impact of unlocking some existing home supply. So we'll keep an eye on that. Even so, through July's data, the Atlanta Fed's real time GDP trackers tracking 2.5% real growth in the third quarter. And here on Monday morning, we just got a fresh read on the non manufacturing sector, which indicated that there's expansion in the service sector still. There's not a lot of other consequential macroeconomic data here in the US this week. Jobless claims on Thursday is about it. So we'll take a look at that number to see if it corroborates labor market weakness or not. Now, from a trend perspective, we should also take note that the market participation, in other words, how many stocks are advancing, that was very strong as recently as just 2 weeks ago. Historically, this so called market breadth tends to weaken well in advance of bull market peaks. Now, that's not an unbreakable rule or anything, but history suggests that this spell of volatility is more likely to be a contained correction than the start of a bear market. Looking at past seasonal trends, August and September have easily been the worst 2 month combination for stocks. And usually an election year has an upward bias, but that flattens out when an incumbent is not up for reelection. So our base case here would be a volatile few weeks ahead, but the resumption of the bull market when the dust settles. So join us next week to get our take on how markets are evolving in these next few days and whether that does anything to change that impactful data that we always want to weigh. As always, thank you for taking the time with us and tuning in.